There's a debt sitting in your life right now that doesn't show up anywhere. Not on your credit report. Not on a statement. Not even in your own head most of the time. You didn't take out a loan. You just clicked a button at checkout. For easy payments. No interest. Felt like nothing. And that feeling, the feeling that it was nothing, is the entire trap. Last year, 24% of the people using these split payment plans fell behind. Not on a mortgage. On 4 payments for a pair of shoes. Here's the part that should bother you. For years, the companies handing out this money were not telling anyone. Not the bureaus. Not the banks deciding whether to give you a car loan. Nobody could see it. It was a number that even your own bank couldn't pull up, until this year when the rule quietly changed. So I'm going to show you exactly how a debt this big stayed invisible for this long. And I'm going to show you the one thing that's true about every single one of these loans, no matter how small it looks. It wasn't a loan to you. It was always a loan to them. Quick note on where this is coming from, because I don't want you to take my word for any of it. I went through the federal data, the Consumer Financial Protection Bureau, the Federal Reserve's Household Survey, the regional Fed research. The stuff with actual transaction records behind it, not a press release from a company that profits from you using the product. I read the reports so you don't have to, and what's in them is a lot clearer and a lot stranger than the marketing. Because the marketing tells you this is a smarter way to pay. The data tells you who's actually using it, why, and what happens to them 6 weeks later. Let's start with the simplest question. What is this thing, really? Picture every debt you have as something that casts a shadow. A mortgage casts a long one. A car loan, a credit card balance, a student loan, they all leave a mark. A lender shines a light, and there it is. They can see what you already owe before they decide to lend you more. That shadow is the whole point of a credit report. It's how the system keeps anyone from handing you more rope than you can climb down from. Now picture a debt that casts no shadow at all. You owe the money. The obligation is real. The payments come out of your account on a schedule. But when a lender shines the light, nothing. No mark on the wall. As far as the system is concerned, it isn't there. That's buy now, pay later. A debt with no shadow. And for years, that wasn't a bug. That was the design. Let's get concrete. The most common version of this is what the researchers call pay in for. You buy something. You pay 25% today. Then 3 more equal payments every 2 weeks until it's done. 6 weeks for payments and usually no interest if you pay on time. On the surface, that's a genuinely good deal. No interest is no interest. If you were going to buy the thing anyway and you pay on time, you came out ahead of a credit card. So far, nothing sinister. Hold on to that because the honest version of the story matters here. Now here's where it gets interesting. When you take out one of these loans, the company usually does what's called a soft check. A glance. Not the hard pull a credit card or a car loan does. A soft check means almost anyone gets approved, almost instantly. No long application. No real look at what else you already owe. And then, this is the key part, most of these companies, for the basic pay-in-for product, did not report the loan back to the credit bureaus. Think about what that means. They didn't check what you owed. And they didn't tell anyone what you now owed them. So the next company you walk up to, the next app, the next checkout, they can't see the first loan either. Neither can your bank. Neither can the lender deciding on your mortgage. Every door opens like it's the first door. Every time. The federal researchers have a clinical name for the risk this creates. They call it loan stacking. Taking out multiple of these loans at the same time, often across different companies, with no one able to see the full picture. That term loan stacking is the thing this entire video is about. So let's pull it apart and see how the stack actually gets built. Here's the trick your brain plays, and it's not your fault. It's the math being hidden from you on purpose. When you buy a $135 item with pay in 4, your brain does not file it as, I owe $135. It files it as, I paid about $34. Because that's what left your account today. The other 100 is in the future, and the future doesn't feel like a bill. Feels like nothing. 135 is the average. That's not me guessing, that's the average BNPL transaction in the federal data, adjusted for inflation. Now watch what happens when you do it 5 times. which, by the way, is not unusual. It's normal. 5 purchases, $135 each. That's $675 of debt. Real money. Real obligations with real due dates. But you never, ever see the number 675. It does not appear anywhere. There's no statement that adds it up for you. What you see instead is $34. Then 34 more. Then 34 more, but on a Tuesday, then a different Thursday, then the following Monday, because every loan is on its own little 2-week clock. 5 small clocks, all ticking, all out of sync. And in any given 2 weeks, 2 or 3 of them go off at once, and $100 vanishes from your account that you never planned for as a single bill. That's the engine. Big debt. Chopped into pieces small enough that none of them ever triggers the part of your brain that says, wait, can I afford this? And the federal data shows this is exactly what's happening at scale. More than 60% of these borrowers held multiple loans at the same time during the year. A third had loans out with multiple different companies at once. 63%. Stacking isn't the edge case. Stacking is the median experience. And it's accelerating. The average borrower went from 8.5 of these loans in a year to 9.5. About 1 in 5 users now takes out more than one loan every single month. Let me say the quiet part. A product that pays the company every time you open a new loan, that approves you in seconds, that hides the running total from you. Of course usage goes up. It was built to go up. That's not a conspiracy. That's just incentives. The rule is simple: don't look for evil. Look for who gets paid. And here's a thread I want you to hold on to, because we're going to pull it later. When the company that makes your credit score finally went digging into the stacking behavior, they found something strange about the people with the most loans. The people with 5 or more. Not what you'd expect. Park that. We'll come back to it. Because first, you need to see who actually gets hurt when the stack gets too tall. Let's talk about a guy. I'll call him Marcus. 28, makes somewhere in the high 30s, not broke, not comfortable. The exact middle where most of this happens. Marcus isn't reckless. He doesn't have a maxed-out credit card. In his own head, he's being responsible. He's using these plans to smooth things out between paychecks. Spreading the cost. That's the pitch, and he bought it. And Marcus is not alone in his income bracket. The people who earn between $25,000 and $50,000 a year have the highest usage rate of all. Here's where it stops being smooth. Last year, 24% of all these users were behind on payments, up from 18% the year before, almost 1 in 4, and it's not spread evenly. Among people Marcus's age, under 30, it's 32%. Nearly a third of young users late at least once. Compare that to people over 60, where it's 12%. The younger you are, the deeper in this you are. And here's the line that should stop you. More than half of these users say they couldn't have afforded the purchase any other way. Among people earning under $50,000, it's 72%. Read that again slowly. 72%. This isn't a convenience tool for most of them. It's the only way the thing gets bought at all. That's not a statistic. That's a person standing at a checkout, deciding between the groceries and not the groceries, and reaching for an app because it's the only door that opens. And we know the late payers aren't just unlucky. The regional Fed research is blunt about it. Of the people who paid late on these loans, 96% were at least mildly financially stretched. Among the people who didn't pay late, it was 86%. The late payment isn't random. It's a signal. It's the sound a budget makes right before it breaks. So back to Marcus. He's got a few of these going. He's never missed by much. A few days here, a reminder he ignored there. In his head, he's fine. Then Marcus decides he wants to finance a car. And he walks up to a lender feeling pretty good about himself. And the number on the screen is not the number he expected. To understand why, you have to understand what changed this year. For this entire video, I've been telling you this debt was invisible. No shadow. The bureaus couldn't see it, the lenders couldn't see it, and honestly, neither could you. That was true. Past tense. Because in 2025, the most important name in credit scoring did something about it. FICO, the company whose 3-digit number decides whether you get a mortgage, a car, an apartment, announced the first credit scores that actually pull in buy now, pay later data. They're called FICO Score 10 BNPL, and they started rolling out in the fall of 2025. For the first time, the debt that cast no shadow can show up on the wall. So that thread I told you to hold on to, the strange thing FICO found about people with 5 or more loans. Here it is. You'd assume more loans means a worse score. More debt, more risk, number goes down. That's the obvious story. FICO ran a joint study with one of the biggest lenders on a sample of more than 500,000 of these borrowers. And what they found is that people with 5 or more loans typically saw their scores go up or stay about the same under the new model. Sit with how strange that is. The stackers, the people doing the exact behavior I just spent 5 minutes warning you about, mostly didn't get punished. Why? Because the new score isn't measuring whether you stacked. It's measuring whether you paid. And it turns out a lot of stackers do pay on time every time. For them, the change doesn't hurt. It finally lets them prove they're reliable, on a record nobody was keeping before. So the change isn't a punishment. It's a light switch. It doesn't make the debt bigger. It makes the debt visible. And visibility cuts both ways. If you pay on time, the system can finally see that and reward it. If you're one of the 24% who falls behind, now that gets seen too. Which brings us back to Marcus, standing at the car lender with a number on the screen he doesn't recognize. Marcus felt invisible because his debt was invisible. He'd built a whole sense of his own finances on a number that left out the 4 apps quietly pulling $34 at a time from his checking account. The rule changed. The light came on. And the lender is now looking at a Marcus that Marcus himself never bothered to add up. Because here's the thing he never understood about any of those loans. It wasn't a loan to him. It was always a loan to them. Let's stay with Marcus because his story is the whole point, and I want to follow it all the way down. Rewind a year. Marcus gets a notification. His favorite brand, a jacket he's been eyeing, and a little button under the price. 4 payments of $37. No interest. He doesn't think of it as borrowing. Nobody does. That's the genius of the button. It doesn't feel like a loan. It feels like a discount on the pain of paying. Couple weeks later, it's a pair of sneakers. Then a gift. Then, and this is the moment the federal data says is becoming normal, it's groceries. Because survey after survey, from the lender's own marketplaces, the number keeps climbing. People using these plans not for a jacket, but for the cart at the supermarket. Roughly 1 in 4 BNPL users now, up from about 1 in 7 2 years earlier, by those market surveys. I flagged that one as a survey, not a federal record, so take the exact figure loosely. But the direction is the thing. When the plan you used for a luxury jacket becomes the plan you use for eggs and milk, something has shifted, and it isn't good. For Marcus, by month 4, there are 5 of these running. A jacket, sneakers, a birthday gift, a phone case, and yes, twice now, the grocery run when the week got tight. None of them is big. The biggest is $40 a payment. In his head, each one is a rounding error. He has never once seen them added together, because nothing ever adds them together. 5 loans. Call it 600-something in obligations, the way we worked it out earlier. Spread across 5 different 2-week clocks. Marcus could not tell you that total if you asked him. He genuinely does not know it. And that's the crisis. And it's so quiet he doesn't even notice it happening. It's not a dramatic blow-up. It's a Tuesday where 3 payments land at once and his card declines at lunch. It's a late fee he didn't budget for. It's the slow, grinding feeling that he makes okay money and somehow there's never anything left. Here's the resolution, and it's not the one he wanted. The day he walks up to that car lender and sees the unfamiliar number, Marcus finally learns the total. A stranger, a computer at a dealership, adds up his life before he ever did. And the lesson isn't Marcus is bad with money. Marcus did exactly what the product was designed to make him do. The lesson is colder than that. The debt was always there. The $600 existed the whole time. The only thing that ever changed was whether someone could see it. For years, nobody could, including Marcus. Then the rule flipped, and the first person to see the real Marcus was a lender about to say no. That's the trap. Not the interest. Not even the late fees. The trap is being the last person to find out what you actually owe. Now I have to be fair because if I'm not, I'm doing the same thing the marketing does, just in the other direction. Here's the honest case for buy now, pay later, and it's stronger than the haters admit. These loans actually have a low default rate. In the federal data, the share of these loans charged off, written off as unpaid, fell from 2.6% to 1.8% in a single year. And research that tracked people who hold both products found something telling about how they pay. They default on these loans far less than on their credit cards, about 2% versus 10%. Read carefully, that means buy now, pay later is not the most dangerous product in your wallet. By the numbers, it might be one of the safer ones to pay off. And for someone with a thin credit file, no long history, no easy way to prove they're reliable, the new visible version could genuinely help. Pay on time, and now there's finally a record of it. That's a real door opening for people the old system ignored. So this video is not buy now, pay later is a scam. It isn't. The mechanics are mostly honest. The interest, when there's none, is genuinely none. The problem was never that it's the riskiest debt. The problem is that it was the most invisible debt. Low risk you can see is fine. Low risk that hides from you and stacks while it hides is how a responsible person like Marcus wakes up owing more than he ever decided to. It wasn't the danger of the loan. It was the silence around it. Alright, you know how the trap is built. Now let's talk about what you actually do with that, because knowing isn't the point, using it is. First, add them up. Right now, today. Open every app, every account, and write the real total on one piece of paper. Not the prepayment number. The whole number. The 675, not the 34. The single most powerful thing you can do against an invisible debt is to make it visible to yourself before a lender does it for you. Second, one rule, and it's the oldest one in the book. Never use one of these for something you couldn't pay for in cash today. If you can't afford it now, splitting it into 4 doesn't make you able to afford it. It just delays the moment you find out you couldn't. Third, watch the calendar, not just the price. The danger isn't any single payment. It's 3 of them landing in the same week. If you're going to stack, at least know when the clocks go off. And fourth, the one that matters most. The day you find yourself reaching for one of these to buy groceries. Stop and notice it. That's not a payment strategy. That's a signal. It's your budget telling you something the apps are built to help you ignore. None of this requires a spreadsheet or a finance degree. It requires you to do the one thing the product was designed to prevent. Look at the whole number. So let's close the loop we opened at the start. I told you there was a debt in your life that didn't show up anywhere. A number even your bank couldn't pull up. Now you know why, because the people lending it never wrote it down where anyone could find it. There's a name some economists started using for this. Phantom debt. Money that's owed, payments that are real, obligations that are absolutely there, but that haunt the edges of the financial system without ever fully appearing in it. And the thing about a phantom is that it's there whether or not you can see it. The $600 was real when it was invisible. It was real the whole time. This year, FICO turned on a light. The phantom is starting to take shape on the wall. For people who pay on time, that's good news, they finally get credit for it. For people quietly drowning in $34 payments, the light is going to show something they've been avoiding. Either way, the move is the same. Don't wait for the light to be turned on for you. Turn it on yourself. Add up the number nobody's been adding up. Because here's the one thing that was always true about every loan, no matter how small the button made it look. It wasn't a loan to you. It was always a loan to them. The only question that ever mattered was whether you'd be the last one to see it. Now you won't be.